If you own a corporation in Canada and you have money sitting inside it, you're probably paying way more tax than you need to. And I don't mean a little more. I mean potentially hundreds of thousands of dollars more in your lifetime. There's a strategy that lets your corporation grow wealth tax-sheltered and eventually transfer it to your family tax-free. It's called corporate-owned life insurance, and in a moment, I'm going to walk you through exactly how the money flows, step by step. I'm Greg, founder at Dundas Wealth. We're an independent licensed brokerage. We specialize in helping incorporated business owners across Canada use tax-efficient insurance strategies to keep more of what they earn. Because we're independent, we work with over 20 Canadian insurers to find the right structure for your situation. By the end of this video, you'll know exactly what corporate-owned life insurance is, how it works mechanically inside of your corp, who it makes sense for, and who it doesn't make sense for. I'll even run through a real example with actual numbers. Let's get into it. What is corporate-owned life insurance? Let's keep it simple. Your corporation buys a permanent life insurance policy on your life. The corporation is the owner, the corporation is the beneficiary. And the corporation pays the premiums using corporate dollars. Why does this matter? Because corporate dollars are cheaper than personal dollars. If your corporation is an active small business in Ontario, you're paying about 12.2% tax on the first $500,000 of active income. Compare that to your personal marginal rate, which could be over 53%. So every dollar your corp spends on premium costs, way less than if you paid for it personally. Inside a permanent life insurance policy, whether it's a whole life or universal life, there's an investment component. That investment grows tax-sheltered. No annual tax on the gains, no T-slips every year. That's a big deal when you compare it to investing inside your corporation in, say, stock portfolio or GICs, where the passive income gets taxed and can even claw back your small business deduction. How the money flows. Let me walk you through the mechanics. This is the part most people don't fully understand, and it's the most important part. Step 1. Your corporation has retained earnings. Profits sitting in the business after you've paid corporate tax. Instead of leaving all that cash in a savings account or a taxable investment portfolio, you direct a portion into a permanent life insurance policy. Step 2. Those premiums go into the policy. Inside the policy, the cash value grows. And here's the key. That growth is tax-sheltered. Year after year, it compounds without triggering passive investment income on your corporate tax return. Step 3. This is where the magic happens. When you eventually die, and I know nobody loves talking about this, the death benefit gets paid to your corporation. Now here's what most people miss. The death benefit minus something called the adjusted cost basis, or the ACB, of the policy gets credited to your corporation's Capital Dividend Account, the CDA. Step 4. Money in the CDA can be paid out to your shareholders, your spouse, your kids, whoever inherits the shares as a capital dividend, tax-free. Tax-free money flowing from your corporation to your family. That's the whole play. Corporate dollars go in, tax-sheltered growth happens. Tax-free money comes out to your family. And along the way, you've avoided the passive income problem that hits so many incorporated businesses. Let's run the numbers. Let me make this real. Let's say David is a 50-year-old business owner in Ontario. He has $800,000 of retained earnings in his corporation. He's healthy, his kids are grown, he wants to make sure his wealth transfers efficiently to the next generation. Option A, David invests that money inside of his corp in a balanced portfolio. Let's say he earns 5% annually. On that passive income, his corp is paying about 50.17% in tax on investment income in Ontario. So his after-tax return is roughly 2.5%. And remember, once his passive income crosses $50,000, he starts losing his small business deduction on active income. That's a hidden cost a lot of people forget about. Option B, however, David puts a portion of those retained earnings, let's say $40,000 a year, into a corporate-owned whole life policy with a $1.5 million death benefit. That value grows tax sheltered. No impact on his passive income calculation, no clawback of the small business deduction. Let's fast forward. David is now 80. Assuming he's been paying premiums for 30 years, the policy's cash value might be somewhere around $900,000 to $1.1 million, depending on the insurer and the dividend. But the death benefit is $1.5 million or more. When David dies, that $1.5 million flows into the corporation. Most of it gets credited to the CDA. His family receives a tax-free capital dividend. Compare that to option A, where the invested portfolio might be worth a similar amount, but getting it out means paying dividend tax, potentially 39% to 47%, depending on the type of dividend. The difference? Hundreds of thousands of dollars that stay with David's family instead of going to the CRA. Who is this for and who is it not for? Now here's what most people get wrong. They hear tax-free and think this is for everyone. It's not. Corporate-owned life insurance makes the most sense if you have significant retained earnings in your corp that you don't need for operations. If you're in a high-tax province, if you plan to keep your corporation long-term, and if you have a genuine need for life insurance, whether that's estate planning, wealth transfer, or even funding a buy-sell agreement with a business partner. It does not make sense if your corporation is cash-strapped. If you're going to need that money in the next 5 to 10 years, permanent life insurance is a long-term play. If you cash it out early, you can lose the money. Surrender charges are real. This is not a savings account. It also doesn't make sense if you don't actually need life insurance. Buying a policy just for the tax benefit with no real insurance need, a good advisor will tell you that up front. And at Dundas Wealth, we will. We break down strategies like this for Canadian business owners every single week. The passive income advantage. Now, here's where it gets interesting. For business owners who are already dealing with the passive income rules, since 2019, if your corporation earns more than $50,000 in passive investment income, you start losing access to the small business deduction. For every dollar over $50,000, you lose $5 of that small business limit. Hit $150,000 in passive income, you lose the entire deduction. That means your active business income goes from being taxed at 12.2% to being taxed at 26.5% in Ontario. That's a massive jump. And if it hits business owners who are doing the responsible thing, saving money inside the corp, here's what corporate-owned life insurance fixes. The growth inside of a life insurance policy is not considered passive investment income. It doesn't count towards that $50,000 threshold. So you can shelter significant wealth inside of the policy and protect your small business deduction at the same time. It's one of the few strategies that does both. We worked with a client, an independent consultant who also had a growing real estate portfolio, was creeping right up to the CRA threshold. He was about to lose his small business deduction entirely. We set up a corporate-owned permanent life insurance strategy. It let him continue building wealth, tax-sheltered, without triggering the passive income penalty. He kept a small business deduction. He's still on track for early retirement, and his family has a guaranteed tax-free legacy in place. That's the real outcome. That's what the strategy does when it's set up correctly. If this is relevant to your situation, I'll leave a link below, dundaswealth.ca/apply. We'll look at your specific numbers and tell you if this strategy makes sense for you. All right, let's bring it all together. Here's what you need to know. 1. Corporate-owned life insurance lets your corporation buy a policy using cheaper corporate dollars. 2. The cash value grows tax-sheltered inside the policy. It doesn't trigger passive income rules. 3. When the death benefit is paid, it flows through the Capital Dividend Account. It can be distributed to your family tax-free. If you're a business owner with retained earnings and you want to see what this looks like with your actual numbers, book a free strategy call at dundaswealth.ca/apply. No pressure, no obligation, just clarity. Thank you for watching. I'm Greg from Dundas Wealth, We'll see you in the next video.